Everyone thinks the recession warning already came and went. The yield curve inverted. Everyone panicked. Then it even inverted. And the economy just kept going. So the story now is simple. We dodged it. Soft landing. Move on, except there's one problem with that story. The warning everyone's watching expired. The one nobody's watching is just getting started. Right now, trillions of dollars in corporate debt are sitting on a countdown clock. Debt issued back in 2020 and 2021, when the Fed had rates pinned near zero. Back then, companies weren't stupid. They saw free money, and they took as much of it as they could get, locking it in for 5, 7, 10 years. Cheap debt, long run, no urgency.
But debt isn't a gift. It's a loan with a return address. And starting this year through 2027, more than $2.5 trillion of that debt comes due. Every single dollar of it has to be paid back or rolled into new debt. And new debt today doesn't come at 2%. It comes at 6, 7, sometimes 9%. This is what's called the maturity wall. And it's not a metaphor. It's a date on a calendar that doesn't move. Here's why this matters to you, and not just some hedge fund analyst. When a company refinances debt at triple the interest rate, that money has to come from somewhere. Layoffs, price hikes, canceled expansion, delayed hiring. The company doesn't absorb that cost quietly. It passes it directly into the economy you're standing in. So, to understand what's coming, we need to understand what happened the last time a wall like this hit. Rewind to 1989. The savings and loan industry had spent the 80s handing out debt like candy, funding real estate deals that made sense on paper as long as rates stayed low forever. Rates didn't stay low forever. Volcker's brutal hikes from the start of the decade eventually caught up with them, and by the end of the 80s, over 1,000 savings and loan institutions collapsed under debt they could no longer service. It wasn't one bad decision. It was thousands of companies discovering their debt had a due date, all around the same time. That's the pattern. Debt doesn't cause the crisis. Timing does. Which brings us to the part almost nobody's talking about. Rates didn't just go up this cycle, they went up faster than almost any period in modern history. The Fed took rates from near zero to over 5% in about 18 months. For comparison, that's a move that historically took 3 or 4 years, compressed into 1.5. Companies that borrowed cheap in 2021 didn't get a slow, gentle runway to adjust. They got a cliff. And here's the number that should actually worry you. Roughly 40% of investment-grade corporate debt and more than half of high-yield junk debt was issued in that 2020 to 2021 window. That's not a small pocket of risky companies. That's a huge chunk of corporate America, all financed at the exact same moment, all coming due in the exact same window. So who actually gets hit first? Not the giants. Apple and Microsoft can absorb a rate shock without blinking. They're sitting on mountains of cash. The real exposure sits one tier down, in the mid-size public companies and the private equity portfolio companies nobody puts on the evening news. These are businesses carrying debt loads of 4, 5, 6 times their annual earnings, the kind of leverage that only works if the interest rate stays where it was when they signed the loan. Private equity is the part of this story that deserves its own segment, because here's the mechanic almost nobody outside finance actually understands. When a PE firm buys a company, it typically doesn't pay in cash. It pays with debt loaded directly onto the company it just bought. The company you've heard of, the mattress chain, the salon franchise, the regional grocery brand, isn't just running its business. It's also carrying the loan that bought it in the first place. For over a decade, that structure worked beautifully because refinancing that debt every few years at near zero rates was basically free. Extend and pretend. Roll it forward. Pay a little interest. Repeat. Nobody had to actually solve the debt. They just had to keep kicking it another 5 years down the road. But you can't roll debt forward forever if the price of rolling it just tripled. And that's exactly the position thousands of these companies are in right now. According to Moody's, the volume of distressed exchanges, companies renegotiating debt terms just to avoid outright default, hit its highest level since the 2008 financial crisis. That's not a headline. That's the ground shifting quietly under your feet before you feel the earthquake. So we've established the wall is real, and we've established who's exposed. The real question is what happens when it hits. Here's the mechanism most people miss. It's not one dramatic collapse. It's not a single Lehman moment. It's slower and quieter than that, and that's exactly what makes it dangerous. Companies facing this wall have three options, and only three. Refinance at the new higher rate and eat the cost. Sell assets to pay down the debt before it's due. Or default. Each of those options drains the same well. Refinancing pulls cash out of hiring and expansion. Asset sales flood the market with properties, equipment, and business units all being sold at the same time by companies under the same pressure, which pushes prices down for everyone selling. And default doesn't just hurt the company, it hurts every bondholder, every pension fund, every lender standing behind it. Let's zoom into one real case, because abstractions don't land the way specifics do. Take the private equity-owned retail and services sector broadly. Companies like the ones behind familiar mall and strip mall names you'd recognize instantly if I said them. A huge share of that sector was bought out during the cheap debt years of the mid-2010s and refinanced again during the free money window of 2020 and 2021. Those loans are now maturing directly into a rate environment. Those business models were never underwritten for. Revenue didn't triple. The interest bill did. That's the blueprint for the entire wall, repeated across thousands of companies you've never heard of, at the exact same time, for the exact same reason. And this is where it stops being a corporate story and becomes your story. When mid-sized companies cut costs to survive refinancing, the first thing to go is headcount. The second thing to go is expansion, meaning fewer job openings across the board, not just at the companies directly affected. Credit gets tighter everywhere because banks watching this unfold get more cautious lending to everyone, including you. So here's where we land. The last recession warning, the inverted yield curve, was a siren. Loud, obvious, and by the time you heard it, priced in. This one isn't a siren. It's a slow-moving pressure building under a surface that still looks calm from where you're standing. Gas is cheap. Stocks are near highs. The headlines say soft landing. But underneath, over $2.5 trillion is quietly walking toward a door that opens into a completely different interest rate world than the one it was built for. Maybe it gets absorbed smoothly. Maybe the Fed cuts fast enough to soften the landing before the wall fully hits. Or maybe we're all about to find out what happens when thousands of companies discover their cheap debt had an expiration date, all at once. I don't know which version we get. Nobody does yet. But I know what I'm watching for. And now, you do too. Drop a comment and let me know. Do you think this gets absorbed quietly? Or is this the next real shock nobody saw coming?